Picture this. You found your dream home and it ticks every single box. The location, the layout, the backyard, and you know that if you don't move on it now, someone else is going to. The only problem? Your current home isn't sold yet and all of your money is tied up in it. So what do? Do you let it go and hope that something else just as good comes up later? Or is there actually a way to buy your next home before you sold your current one? There is, and in this video, we're going to explain everything that you need to know. Most people who want to upgrade, downsize, or relocate run into the exact same problem. You can't easily buy your next home without selling your current one first, because that's where most of your equity is sitting. But you also don't want to sell your current home until you found the next one, because then you've got nowhere to live, and suddenly you're under massive pressure to buy something fast. And it's one of the most stressful parts of the whole moving process. The market doesn't wait for you, and if the right property comes up, you don't have 3 months to figure your life out. You might only have 3 days. And if you're forced to sell your existing place quickly to make the timing work, you could end up selling for a discount simply because you didn't have the time to run a proper sales campaign. This is the exact gap that bridging finance is designed to fill. It gives you breathing room by letting you buy first, sell second, and actually move through the whole thing without the stress. So let's break down how it actually works. Simply put, bridging finance is a short-term loan that lets you buy your new home before you've sold your existing one. It bridges the gap between settling on your new property and selling your old one, hence the name. You may have heard the term thrown around online, or maybe a friend has mentioned it, but most people don't actually know how it works underneath the surface. And that's the bit that matters, because the structure of a bridging loan is different to a standard home loan. When you take out a bridging loan, the bank breaks your total debt into 2 parts. There's a bridging portion, which is a temporary debt that gets repaid when you sell your existing home. And then there's the end debt, which is what you're left with as your normal home loan after the sale goes through. Add those two together and you get what's called the peak debt, which is the debt you'll carry through the bridging period. So let's walk through how the bank actually calculates all this. The first thing a lender will do is look at your current property and decide how much of its value they're willing to count towards a bridging loan. Most lenders will use about 80 to 85% of your current property's value. They do this to build in a buffer in case a property sells for less than expected, or in case the sale takes longer than planned. In some cases, lenders will stretch this to 90 or even 95%, but usually only if you already hold an unconditional contract to sale on your existing home. At that point, the risk to the bank is much lower because the sale is essentially locked in. The next thing they do is look at the total loan to value ratio, or LVR, on your peak debt. LVR is just the size of your loan compared to the value of the property securing it. For bridging, the peak LVR is usually capped at around 80%, but that can be lower depending on the postcode of your properties and the specific lender's appetite. And that LVR is calculated across both properties combined, the one you're selling and the one you're buying. They will also look at the LVR of the end debt, as you'll often need an LVR under 80% once your existing property is sold and the bridging loan is gone. Now, your servicing, which is the bank's calculation of whether you can afford the loan. This is generally based off the end debt, not the peak debt. So they're working out whether you can comfortably manage the ongoing loan once your existing home is sold and the bridging portion is gone. And finally, the interest on the bridging portion of the loan is usually capitalized. That means instead of you paying interest every month out of your own pocket, the interest gets added to the loan balance and is repaid when you sell the home. Some lenders don't capitalize it, and in that case you either need to service the full peak debt from your current income or have enough savings sitting there to cover the interest during this bridging period. One last thing you need to know is that the interest rate on the bridging portion of the loan is usually higher than the standard home loan rate. We're talking typically 2 to 3% above what you pay on a normal loan. That's the bank pricing in the short-term, high-risk nature of the bridging period. Now, I know that's a lot of moving parts, so let's walk through it with an actual example. Let's say you currently own a home and it's worth $1.2 million, and you've got an existing mortgage on it of $400K. You found a new property you want to buy, and that's $1.5 million, and we'll assume the purchase costs of around 5%, so that's about $75,000 to cover things like stamp duty, legal fees, and so on. The first thing we work out is the maximum bridging amount. The lender will use 85% of your existing property's value, which gives us $1.02 million. Next, the total funds you need to make this whole thing work. That's your existing mortgage of $400K, plus the new purchase price of $1.5 million, plus the purchase costs of $75,000. Add all of that together and you need $1.975 million to fund the entire move. If you're not contributing any savings towards the purchase, That 1.975 million is your peak debt. From that, we subtract the bridging portion of 1.02 million, leaving $955,000 as your end debt. That's the loan you'll be left with once your existing home is sold and the bridging portion is repaid. The peak security position is the combined value of both properties, 1.2 million plus 1.5 million, which gives us 2.7 million. So your peak LVR works out around 73%, which sits comfortably under the 80% cap. Now, here's the part most people don't realize. Because lenders are quite conservative when they're calculating the bridging loans, there's often a surplus once your home actually sells. In this example, let's say your home sells for the full 1.2 million. You pay around 3% in your selling costs, and the bridging period runs for 6 months. Once everything is paid out, the bridging debt, the capitalized interest, the selling costs, you'll likely have somewhere around $96,000 in surplus funds left over. And that money can either be used to reduce your end debt or parked in an offset account against a new loan, which keeps the funds flexible if you need it later. Now, keep in mind that everyone's situation is different. The numbers we've just walked through are an example to show you how the structure works. So make sure you sit down with a mortgage broker who can run your actual numbers before you make any decisions. Bridging is a great tool, but it's not free and it's not without risk. The first cost is the interest rate. As I mentioned, the bridging portion of your loan sits at a premium compared to your standard rate. If your bridging period stretches out for 6, 9, 12 months, that interest really starts to add up. The longer your home takes to sell, the more it costs you. The second cost to be aware of is that some lenders charge a separate risk fee or bridging fee. This is more common with the lower tier or specialist lenders, and it can be as much as 1.25% of the total debt. So on a $1 million loan, you could be looking at $12,500 in fees just to access the bridging product. The good news is that this is usually avoidable if you can structure the deal with one of the mainstream banks, which is one of the things a good broker will work through with you. The third risk, and probably the biggest one, is that your home might take longer to sell than you expect. If the market shifts or your property doesn't get the interest you're hoping for, you could be sitting on your bridging debt for much longer than planned, racking up interest the entire time. Most lenders will allow you to extend the bridging period if things drag on, but it's not free and it's something you need to be aware of before you get into it. If you're seriously considering bridging, there are a few things you can do to set yourself up for the best possible outcome. Number one is be ready to put your home on the market as soon as possible. I see this mistake all the time. People buy the new home, they move in, and then they start to prepare the old one for sale. Every week you wait is another week of bridging interest. Ideally, your home is listed and being marketed before you even settle on the new one. Number two, know your numbers before you go shopping. Talk to a good broker first. Understand what your maximum bridging loan looks like, what your end position will be, what your monthly repayments will look like once everything settles. Walking into an auction or making an offer without that clarity is how people get themselves into trouble. Number three, try to line up your settlement dates as close as possible. This is a really important one that a lot of people miss. You only pay bridging interest from the moment you settle on your new property until the moment your old one sells. The smaller that gap, the less interest you're going to pay. And in some cases, which is a dream scenario, you can be approved for a bridging loan but end up not needing it at all because the timing lines up perfectly. In that case, having the bridging approval just gives you a safety net and it costs you nothing. Now, bridging suits a few different types of clients really well. The first group is people wanting to downsize or relocate. Maybe the kids have moved out, maybe you're moving closer to family, maybe you just want a different lifestyle. Bridging lets you find the right next home without the panic of needing to sell first. The second group is people with strong equity who want to upgrade. If you've owned your home for a while and built up some real equity, bridging can let you secure the bigger or better located property without having to sell into a rush time frame. And the third group, which a lot of people don't realize, is people who have no mortgage at all. Retirees are a really common example. If you own a property outright and you're planning to downsize, you might be able to do the whole move with a bridging loan that requires no ongoing repayments and no income servicing because the interest just capitalizes and gets paid out at the sale of the property. It's purely a tool to fund the in-between period, and at the end of it, you're moving into a new place with no ongoing debt. Bridging isn't the only way to handle this situation, so let's quickly go through the other main options and where each one fits. The first alternative is a simultaneous settlement. This is where you buy and sell on the exact same day or close to it. If your sale settles on or before the day that your purchase settles, the bank can use the sale proceeds directly to fund the purchase. On paper, this is cheaper than bridging because there's no bridging period and no extra interest. But the catch is, lining up two settlements perfectly is hard, and if you're forced to accept a lower offer just to make the dates work, you could easily lose more on the sale price than you would have spent on the bridging interest. It can also be a logistical nightmare moving out of one home and into another on the same day. Most people end up with furniture and storage and a few nights in a hotel. The second alternative is a rent-back agreement. This is where you sell your current home, but you negotiate with the new owners to stay in it for a set period, usually a few weeks to a few months, while paying them rent. That gives you the time to find your next property and move in without the same pressure. The downside is that you're paying rent during this period, and some buyers won't agree to a rent-back clause, which can reduce the pool of potential buyers and potentially a sell price. The third alternative is renting or staying with family for the in-between period. Some people sell their current home, move into a rental or in with parents, and then take their time to find the next perfect property. It removes a lot of the stress, but it has real downsides. The Australian rental market is incredibly competitive at the moment, and most rentals require a minimum 12-month lease. So if you find your next home 3 months in, you've either got to pay break costs on your lease, or you're paying rent and a mortgage at the same time. And in a rising market, every month you're out of the property cycle is a month where prices may have moved against you. I've seen cases of people selling and planning to buy again in 6 months and then finding themselves priced out of the suburb that they used to live in. If you've watched this whole video, chances are you're either thinking about upgrading, downsizing, or relocating, and you want to understand whether bridging is the right move for your situation. That's exactly the kind of scenario we love getting into. So if you want to know how bridging would actually look for your specific numbers, the next best step is to book a call with me. It's free, there's no obligation, and it'll map out exactly where you stand and what your options are. The link to book is in the description below, and I'll genuinely love to help you work through it. Thanks for watching, and I'll see you in the next one.